Hey guys, Scott Johnson here with Pitt Home Buyers. I just wanted to reach out to you today to talk about this article. Super well timed. Actually, my partner actually wrote up this article and I'm like super excited about it because it is the end of January. And what do we do at the end of January? Taxes! Get excited, guys. Remember the April 15th deadline. But just precursor, I gotta let you guys know I am not giving any investment or financial advice. I'm just outlining some of the great points that are made in the article. All right. So first one that I'm really excited about is if you are selling a personal home and you will not get taxed on that sale up to $250,000. What does that mean? Well, it means that if you sell a $300,000 house for $300,000, you will get taxed at your tax bracket for the $50,000 above the $250,000. Make sure to watch this video a couple of times just to kind of let it sink in because it is a little bit complicated. So always talk to your CPA before selling your house. In fact, if you're selling with a realtor, they may issue a 1099-S, I believe is the correct code for the IRS. And that's going to let the IRS know, okay, this is how much they sold it for. This is how much taxes they're liable to pay. So just a heads up, make sure that you get that form or ask your realtor for that, okay? Now, if you're selling an investment property, it's a different situation because if you're doing something for profit and you sell it, you're going to get taxed on it, just plain and simple. Unless you do a like-kind exchange, totally beyond the scope of this video, but just so you know, that is a thing. Ask your CPA about a 1031 exchange. We have been working with a lot of investors recently. Okay. Let's see. Oh yes. Okay. So if you did buy your property with a first-time home buyer's credit, remember, if you're selling that property within 36 months after purchasing it, you may have to pay back whatever credit you received. Super important. Okay. So make sure you talk to your CPA about that one as well if you bought using the first-time home buyer credit, because you don't want to all of a sudden sell your property and then get a bill from the IRS saying, where's my money? Right? Also, deductions. This is fantastic. Okay, so you can deduct any reasonable expense when you are selling your property. All right, so let's say you do for sale by owner, signs, posting on Zillow and actually paying for the ad, posting, doing paid ads in general, repairing the property, doing things like that to make it look better for the sale. These are deductible expenses. So make sure to keep your receipts. In fact, let me show you something I do. Give you a little trick here. What I do is I actually learned this when I worked over at Bellamy Greenville, over in Greenville, North Carolina, obviously. It's a student apartment complex, and I was a leasing agent out there. I actually got the chance to work with a fantastic property manager who had all his crap in gear. And what he did was he actually took, and you can see Lowe's, what did I buy here? Laser measure and tape measure for assessing properties. I use those. So if you want us to come look at your house and give you an offer and a realtor listing offer, by the way, get excited. I actually use that to measure things when I need to. But what I do is I take a sheet of paper, 3-hole punch it, and then what I do is I tape the receipt to it and write up here the date, the name of the store, how much I paid, and the description. All right. Now, mostly a business move, but at the same time, it's a really super good way to kind of keep your stuff in order when you're selling your house because, like I said, you can deduct those expenses. But anyway, guys, that's it for this video. Already over on time here, but if you have any questions, do not hesitate to reach out. Thanks so much, and we'll talk to you soon.